Okay, in this video, I wanted to cover a common question I get from married taxpayers that are joint owners in a business. So the question is, if I have an LLC that's owned by married taxpayers, whether it's 50-50, 60-40, whatever it might be, do we have to file a separate business tax return? And this question arises because of the issues we see with community property states. So generally, when you have a U.S. LLC, the default tax treatment is when you have more than one owner, it's going to be a multi-member LLC, and it's by default a partnership for federal tax purposes, which means that partnerships need to file Form 1065s, right? It's a partnership tax return. Each partner in the entity gets a K-1, and then they report their allocation of the income on their personal tax return. Now, the one exception to this is if you have married taxpayers living in a community property state. Okay, so the U.S. has 9 community property states, got them listed here. And what this means is when you have a community property state versus what is known as common law states, the assets of each spouse acquired during the marriage are considered assets of the marital unit. So the assets of one spouse are not legally separate from those of the other. It's as if they own it jointly. It's owned jointly, but it's as if the other person owns your share outright. Right, and so it's for this reason that if you have two spouses that are joint owners in an LLC in a community property state, it's as if each spouse owns their LLC units. Okay, and so there's this, I guess, kind of a unique nuance to the tax rules, which say that under this fact pattern, you can have an LLC with more than one owner. That's actually not a partnership, it's a disregarded entity. And so the IRS has addressed this issue. It also came up in a tax court case, this Argosy Technologies case. Basically, what the IRS says, if you have spouses that own an LLC, and they're the only owners, right? You can't have anybody else in there because then that would be a partnership. But if you have married taxpayers that own an LLC and they live in a community property state, they can pick. They can either leave that entity as a partnership, right, because it's a multi-member LLC, or they can treat it as a disregarded entity. So if they want to treat it as a partnership, they can file a Form 1065. If they want it to be a disregarded entity, then they can leave it as a disregarded entity and just report everything on their Form 1040, right? It's up to them. So we look at an example here. We have Jack and Jill. They're married and they live in Arizona. Arizona is a community property state. They decide to open a lawn care business, so they form an Arizona LLC. And the LLC operating agreement, if we look at the appendix, it says that Jack and Jill each own 50% of the LLC membership units. And they're both going to be managing members. So they're both going to be an equity owner and actively participate in the business. Now, they open their business in 2020 and they start doing business. They do $60,000 in gross sales, $40K in expenses, and their profits are $20,000. Now they're going to do their tax reporting. They're trying to figure out what to do. Well, what are their options? Well, if we look at the LLC default treatments, this is a multi-member LLC with more than one owner, so it's defaulting to a partnership for federal tax purposes. So Jack and Jill could go consistent with this default treatment and prepare a 1065 partnership return for the LLC. They each get a K-1 for their 50% allocation of the business profits. And then they go ahead and they file their 1040 and they report the K-1s on their personal tax return. That's fine. They can do that. Or if they want to avoid the partnership tax filing, because they live in a community property state, they can ignore this and just report everything directly on their 1040. So because this is an active trader business, they can add a Schedule C to their tax return, right? Because again, they're engaged in a trader business of lawn care. Schedule C is appropriate when you have an LLC that's a disregarded entity. So they would have the Schedule C, they would report the income and expense. And again, they're only using one Schedule C because the LLC is a DRE for federal tax purposes. Now, another question I get is, well, can they make an S election or a C Corp election? Yes, absolutely, right? So if they have an LLC and they decide that they want to make an S election, well, the S election can go through, and they're still permitted to treat it as if it's just one shareholder, but then they can also do two separate shareholders, right? So they can each have a 50% ownership interest. make an S election, they each get a K1. But whether they have one K1 or two, the point is when you make that S election, you've got to file an 1120S now. You can't use this treatment up here where you just avoid the tax return for the LLC altogether. So if you have a spousal LLC and you make an S election, you are filing an S Corp return now. Okay. And then the same thing with the C Corp election, right? If it's a multi-member LLC, whether it's community property or not, they could still make a C Corp election via a 8832 filing. Okay, so that covers it. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.